China just cut off one of Australia's biggest mining companies overnight, and the fallout could cost BHP $30 billion a year. But this isn't just about iron ore. This is about who controls the future of global trade, and the answer might surprise you. Act 1. The shockwave. Without warning, Beijing made an announcement that sent shockwaves through the global mining industry. All iron ore purchases from BHP, one of the world's largest mining corporations, would be immediately suspended. The message was clear and uncompromising. Even cargo ships already at sea, loaded with Australian iron ore and bound for Chinese ports, would be turned away upon arrival. But there was a catch, a single condition that could reverse everything. If BHP agreed to settle all transactions in Chinese yuan, the RMB, instead of US dollars, trade could resume. For everyone else in the market, business would continue as usual. But for BHP, the clock was ticking. To understand why this matters, you need to understand the scale we're talking about. China isn't just another customer in the global iron ore market. It's the customer. With the world's largest steel industry and an infrastructure boom that's been running for decades, China's appetite for iron ore is practically insatiable. Few nations on Earth possess both the financial resources and the industrial hunger to match China's continuous, massive-scale purchasing power. For BHP, the math is brutal. Lose access to the Chinese market, and the company faces potential losses approaching $30 billion annually. That's not just a bad quarter. That's an existential threat to one of the pillars of the Australian economy. So the question becomes unavoidable. What does this decision really mean for Australian iron ore exporters? Will Canberra bend to Beijing's terms and accept renminbi settlement? Or will Australia stand firm, even if it means watching billions in trade revenue evaporate? Before we can answer that, we need to understand how we got here. Act 2. The Iron Triangle. Three countries dominate the global iron ore landscape: Australia, Brazil, and China itself. But Australia sits at the very top of this pyramid. With reserves estimated at 51 billion tons, Australia controls roughly 28% of the world's total iron ore deposits. But it's not just about quantity. Australian iron ore is exceptional in quality. The ore grade is high, the mining regions are concentrated, and extraction is relatively straightforward compared to other parts of the world. The Pilbara region in Western Australia is the crown jewel. Specifically, the Hamersley Basin has become synonymous with industrial-scale iron ore production. This is where the giants operate. Rio Tinto and BHP have built empires here, turning red dirt into rivers of revenue that flow across the Pacific. And the overwhelming majority of that flow goes to one destination: China. The numbers tell the story. Approximately 83% of Australia's annual iron ore exports head to Chinese ports. In dollar terms, that's nearly $79 billion every single year. To put that in perspective, iron ore alone accounts for roughly 65% of total trade between Australia and China. China isn't just Australia's best customer. For the iron ore industry, China is the only customer that truly matters. But here's the puzzle that confuses many observers. China has its own iron ore reserves. In fact, China ranks among the top countries in the world for total iron ore deposits. So why would Beijing pay premium prices to import Australian ore when they could theoretically mine their own? The answer lies beneath the surface, literally. Chinese iron ore suffers from a fundamental quality problem. Most domestic deposits are what industry experts call low-grade ore. The average iron content hovers around 33%. That means if you dig up 1 ton of Chinese ore, you're only getting about 330 kilograms of actual usable iron. The rest is waste rock that must be processed and disposed of. Compare that to premium Australian ore, which typically contains more than 60% iron content. That's nearly double the concentration. Every ton of Australian ore delivers almost twice the iron for the same weight, which translates directly into efficiency. lower processing costs, and higher quality steel. The problems don't stop there. China's iron ore deposits tend to be fragmented into small and medium-sized mines scattered across vast geographical areas. This distribution pattern makes large-scale, efficient mining operations difficult and expensive. The terrain is often challenging, extraction costs run high, and the logistics of moving ore from remote mines to industrial centers add yet another layer of expense. When you run the numbers, importing Australian iron ore is simply more economical than developing China's domestic reserves at scale. It's a straightforward business calculation, one that has shaped decades of trade between the two nations. But that business relationship hasn't always been smooth. In fact, there was a time when China decided it had had enough of Australian pricing power, and the crackdown that followed revealed just how deep the tensions could run. Act 3. The Price War. BHP has long been one of China's most critical iron ore suppliers. In 2024 alone, the company exported approximately $30 billion worth of ore to Chinese steelmakers. That volume created something dangerous leverage. With such a dominant position in the Chinese market, BHP didn't just supply iron ore, they effectively controlled pricing. As China's imports grew year after year, BHP and other Australian miners had the power to raise prices almost at will. Consider the economics from the mining side. Industry estimates suggest that extracting 1 ton of iron ore costs BHP somewhere around $20. But when that same ton arrives at a Chinese port, the price tag can be several multiples higher. The profit margins were, and continue to be, enormous. Naturally, this imbalance didn't sit well with Chinese industrial planners, but the pricing disputes weren't happening in a vacuum. Geopolitics was about to make everything much worse. The year 2018 marked the beginning of the first major trade war between the United States and China. Australia, under then Prime Minister Scott Morrison, made a clear choice. Canberra aligned itself firmly with Washington and actively participated in efforts to contain Beijing's growing influence. One of the weapons in this economic confrontation was iron ore pricing. During this period, Australian miners deliberately pushed prices higher. The Platts 62% iron ore price index, a key industry benchmark, skyrocketed from $70 per ton to an eye-watering $220. This wasn't just market forces at work. This was resource leverage being used as a geopolitical tool. Australia went even further, attempting to use resource access as a means of strategic restriction. The message was clear. If China wanted Australian iron ore, they would pay premium prices and accept the terms dictated by Canberra. Beijing's response was predictable. China refused to accept this arrangement as a permanent state of affairs. Between 2018 and 2022, China embarked on an aggressive campaign to diversify its iron ore supply chains. The goal was simple: reduce dependence on Australia to a level where Canberra could no longer weaponize resource exports. The results were dramatic. China's reliance on Australian iron ore plummeted from 87% in 2018 to just 40% by 2022. Beijing actively cultivated alternative suppliers, expanded partnerships with mining companies in Brazil and Africa, and even accelerated domestic mining projects despite their higher costs. Then, in 2022, Australian politics shifted. The Morrison government fell, and Labour Party leader Anthony Albanese took power. Albanese moved quickly to repair relations with Beijing, rolling back some of the more confrontational policies and introducing a series of economic and trade normalization measures. The ice began to thaw. By 2024, iron ore trade between China and Australia had largely recovered. Bilateral trade volumes returned to levels not seen since 2017, before the relationship deteriorated. Observers around the world breathed a sigh of relief. It seemed like pragmatism had won. The two countries had too much to lose from prolonged economic warfare, and both sides appeared ready to move forward. And then, without warning, China announced it was suspending all iron ore purchases from BHP. The fragile peace had shattered once again. Act 4. The Currency Card. On September 30th, 2025, Beijing issued a statement that caught the global mining industry completely off guard. All iron ore transactions between Australian exporters and Chinese buyers would now be required to settle in renminbi, China's currency. There would be no exceptions. Even shipments already in transit, loaded at Australian ports and sailing toward China, would face rejection unless the payment terms were adjusted. On the surface, this appears to be a dispute about currency. But dig deeper, and you'll find something far more significant at play. China is making a bid for genuine influence over iron ore trade, something it has lacked despite being the world's dominant buyer for more than 2 decades. Here's the paradox that has frustrated Chinese policymakers for years. China is the single largest purchaser of iron ore on the planet. Chinese steel mills consume more ore than any other country by a massive margin. And yet, China has consistently found itself in a weak position when negotiating prices. Take the current market as an example. The spot price for a ton of iron ore on international markets hovers around $80. But the long-term contracts that China previously signed with companies like BHP often exceeded $100 per ton. That $20 difference might not sound like much, but multiply it by China's annual import volume of roughly 700 million tons, and suddenly you're looking at an additional burden of more than $14 billion every single year. That's money flowing out of Chinese industrial budgets and into the coffers of Australian mining giants. So why has China been unable to negotiate better terms despite its massive buying power? The answer lies in 2 structural problems. First, the international iron ore market has historically been a seller's market. A small number of major producers, primarily in Australia and Brazil, control the vast majority of high-grade ore. This concentration gives sellers significant leverage. Second, and perhaps more importantly, the entire global commodity trading system is built on the foundation of the US dollar. Whether you're buying oil, copper, wheat, or iron ore, the default currency is almost always the greenback. This dollar dominance has created an entrenched system that favors established players and makes it difficult for newcomers, even massive ones like China, to reshape pricing dynamics. By demanding renminbi settlement, China is attempting to chip away at both of these structural advantages. But Beijing hasn't been sitting idle while planning this move. Behind the scenes, Chinese officials have been quietly building the infrastructure needed to support a more assertive stance in commodity markets. The most important piece of this puzzle is the China Mineral Resources Group, a state-backed entity created to consolidate the purchasing power of China's fragmented steel industry. For years, Chinese steelmakers operated independently, competing with each other for supplies and inadvertently bidding up prices. The new group brings all of that demand under one roof, creating a unified negotiating front that can push back against seller pricing power. But there's another dimension to this strategy that goes beyond iron ore. China is using commodity trade as a vehicle for currency internationalization. Right now, despite being the world's second-largest economy, China's renminbi plays a relatively minor role in global trade settlement. The US dollar still dominates, accounting for the vast majority of international transactions. For Beijing, this is both a strategic vulnerability and an opportunity. Commodities like iron ore are ideal targets for currency expansion. They're traded in massive volumes, the transactions are frequent and predictable, and the demand is structural rather than speculative. If China can shift even a portion of global commodity trade into renminbi settlement, it would represent a significant step toward reducing the dollar's monopoly. There's also a risk management component. By settling in renminbi, Chinese companies reduce their exposure to dollar-based financial sanctions, exchange rate volatility, and the geopolitical weaponization of the global financial system. This is about more than just getting a better price on iron ore. This is about reshaping the architecture of global trade itself. ACT 5, the cost of defiance. So what happens to Australia if this standoff continues? What are the real consequences of losing access to the Chinese market? For BHP specifically, the damage could be, well, catastrophic. In recent years, approximately 60% of the company's total revenue has come from the Chinese market. In 2024, BHP exported 250 million tons of iron ore to China, generating more than $30 billion in sales. When China announced the suspension of purchases tied to US dollar settlements, the market's reaction was immediate and, honestly, pretty brutal. BHP's stock price dropped between 3.4% and 4% in a single trading session. The company's market capitalization evaporated by nearly $39 billion in a matter of hours. If China follows through and completely halts iron ore trade with BHP, the company would face annual losses approaching $30 billion. For context, that's roughly equivalent to the entire GDP of some mid-sized nations. But the impact extends far beyond BHP's balance sheet. Western Australia, the state where the Pilbara mining region is located, derives about 80% of its iron ore export revenue from this industry. More critically, roughly 40% of the state government's fiscal revenue comes from taxes generated by iron ore mining operations. If the export pipeline to China gets severed, Western Australia's budget deficit is projected to balloon to approximately $16.4 billion. That kind of fiscal shock would force severe cuts to public services, infrastructure projects, and social programs. Then there's the employment question. Australia's mining sector directly employs around 150,000 workers. When you factor in indirect employment, logistics, equipment suppliers, service providers, and associated industries, that number swells to more than 500,000 jobs. A prolonged freeze in iron ore exports wouldn't just create unemployment. It would trigger mass industrial job losses on a scale Australia hasn't experienced in decades. The economic pain would ripple through entire communities, destabilizing regions that have built their prosperity on mining. In the worst-case scenario, this could evolve from an economic crisis into a structural social crisis with all the political instability that entails. So the question is simple: will Australia compromise? Interestingly, one of BHP's major competitors has already made a move. Rio Tinto, another Australian mining giant, has reportedly agreed to accept renminbi settlement for iron ore transactions with Chinese buyers. For Rio Tinto, the calculation was straightforward. Access to the Chinese market is worth more than ideological resistance to currency terms. But BHP has been slower to bend. And there's a reason for that hesitation. Nearly half of BHP's shares are held by American investors. This means that major business decisions, especially those with geopolitical implications, are subject to influence from Washington. As a close ally of the United States, Australia faces pressure to uphold the dominance of the dollar in global commodity markets. Accepting renminbi settlement for bulk resource trade would represent a direct challenge to that dollar hegemony. It would signal that even close U.S. allies are willing to accommodate Beijing's currency ambitions when their economic interests are at stake. Australia now finds itself trapped between two unpalatable options: defend the U.S. dollar's primacy and risk losing the economic lifeline that iron ore trade with China represents, or accept renminbi settlement and potentially strain relations with Washington. It's a dilemma with no easy answers. ACT 6, the alternative suppliers. But here's the critical factor that makes China's tough stance possible. Beijing is no longer dependent on Australia alone. Over the past decade, China has methodically built a diversified portfolio of iron ore suppliers, reducing the leverage that any single country can exert. The most important alternative source is Vale, the Brazilian mining giant. Vale's annual iron ore production exceeds 300 million tons, generating more than $30 billion in revenue. Since 2006, China has been Vale's largest market. By 2014, more than half of Vale's production was being sold to Chinese buyers. In 2024, Vale exported 328 million tons of iron ore to China, representing virtually 100% of its annual output. This deep commercial relationship has created alignment between the two sides. Vale has officially confirmed that it will not raise prices for Chinese buyers and has agreed to settle transactions in RMB. This decision perfectly aligns with China's current strategic objectives and provides Beijing with a reliable alternative to Australian supplies. But China hasn't stopped at consolidating existing suppliers. Over the past decade, Chinese state-owned enterprises and private companies have been investing heavily in iron ore projects around the world, building supply chains that bypass traditional Western producers entirely. The crown jewel of this strategy is the Simandou iron ore mine in Guinea, West Africa. Simandou is one of the largest and highest-grade undeveloped iron ore deposits on Earth. Proven reserves are estimated at 5 billion tons, with ore grades typically exceeding 65% iron content. In terms of both scale and quality, Simandou is world-class. China's total investment in the project has surpassed $20 billion. The entire value chain, from mine development to railway construction to port facilities, is led by Chinese enterprises, including Chinalco and Baowu Steel Group. The project is expected to begin commercial production by the end of 2025, with an initial annual capacity of 120 million tons of high-grade iron ore. Long-term projections suggest the mine could eventually produce 175 million tons per year. In October 2025, the first cargo ship loaded with Simandou ore is scheduled to arrive at a Chinese port. This moment will mark a turning point. A world-class strategic resource developed with Chinese capital, managed by Chinese companies, and secured for Chinese industry will officially come online. As Simandou's production ramps up over the coming years, China's dependence on Australian iron ore will decrease significantly. Beijing will have achieved something it has sought for decades: genuine supply security and a stronger voice in global iron ore markets. This isn't just about having more options. It's about fundamentally altering the balance of power. Act 7. The bigger picture. Step back for a moment and look at what's really happening here. On the surface, this is a trade dispute about iron ore pricing and currency settlement. But zoom out and you'll see something much larger taking shape. China is systematically reducing its vulnerability to external economic pressure. For years, Beijing watched as the United States and its allies used trade, finance, and resource access as tools of geopolitical leverage. China absorbed those lessons and began building resilience into every critical supply chain. Iron ore is just one example. Similar patterns are playing out in semiconductors, rare earth elements, agricultural commodities, and energy supplies. The strategy is consistent: diversify sources, invest in alternatives, build redundancy, and reduce dependence on potentially hostile suppliers. At the same time, China is using its massive market access as a bargaining chip to advance currency internationalization. Every commodity transaction settled in renminbi instead of dollars chips away at the foundation of American financial hegemony. This isn't happening overnight. It's a slow, methodical process that will take decades to fully unfold, but the direction is clear. For Australia, the choice is stark. Continue aligning with Washington's strategic priorities and risk losing access to the market that underpins much of its national prosperity, or pragmatically accept new terms of trade and maintain economic ties with its largest customer, even if that means accommodating Beijing's currency ambitions. There's no neutral ground here. Australia will have to choose. For the global mining industry, the message is equally clear. The rules of the game are changing. The era of unchallenged Western dominance over commodity pricing and trade terms is ending. New powers are emerging with the financial strength and market access to demand different arrangements. And for the rest of us watching this unfold, it's a reminder that the world order we've grown accustomed to is not permanent. The systems that govern global trade, the currencies that denominate transactions, the power dynamics that determine who sets prices, all of these are up for renegotiation. Closing. China's decision to suspend iron ore purchases from BHP, unless transactions are settled in renminbi, is more than a trade tactic. It's a signal that the old rules no longer apply. For decades, commodity markets operated on a simple principle. Sellers set the terms, buyers accepted them, and the dollar reigned supreme. That model worked as long as buyers remained fragmented and had no alternatives. But China is no longer fragmented, and alternatives are emerging. From Brazilian Vale to African Simandu, Beijing has spent years building the infrastructure needed to challenge the status quo. BHP now faces a $30 billion question. Accept renminbi settlement and keep the Chinese market, or stand firm and watch that revenue disappear. Australia faces an even harder question: loyalty to Washington's dollar system, or pragmatism in the face of economic reality. The answers will reshape more than just iron ore trade. They'll help determine what the global economic order looks like for decades to come. And that's a story worth watching very closely.